because the income statement was rising, right? The income was rising, profits were rising, right? And hence, the world moved from price to book multiples till 50, 60 years ago to price to earnings multiples, because many companies, they started being P&L oriented companies rather than balance sheet oriented in their source of free cash flow generation, right? So that's the second type of business. And remember, for such a company, price to book multiple keeps going up. It still is not an expensive price to book, because actually the relevant multiple was something else. This piece is pretty important when we come to the next type of business. The next type is, let's say, a type 3 company, where the primary driver of free cash flows is actually operating efficiency, some of which might be on the P&L, but a large part of which sits on the cash flow statement, right? If you've got a company which says that, look, I am going to play a volume game, I am going to not worry about price increases, I am going to increase my asset turnover, I am going to compress my working capital cycles, right? If you've got such types of businesses where margins on the P&L is not the primary driver of free cash flows, in fact, incremental reduction in working capital cycles and incremental increases in asset turns, sweating the assets harder, more every year than last year, if that becomes the primary driver of free cash flows, then for such a company, interestingly, earnings growth, profits growth will not be the primary driver of free cash flows, and hence PE multiples will interestingly keep rising, because the share price will reflect free cash flows, but free cash flows will grow far faster than earnings, and hence the share price to earnings multiple will keep rising, right? The moment you look at such a company, PE multiples become less relevant, and pure play DCF, or a price to free cash flow metric, becomes a lot more relevant, right? Now, as we are moving into a world driven by more and more technology, right? Where technology is trying to reduce inventory levels, just-in-time delivery, right? Where technology is trying to square up account settlements with vendors and customers instantly, right? Working capital cycles are shrinking, where the technology is trying to automate manufacturing processes and productivity of workforce is increasing, and hence asset turns are rising. In such an environment where tech investments are going up by leaps and bounds, and they are driving free cash flows beyond just profit growth, in such an environment, if an investor looks at only profits in order to understand the fundamentals of a business, then that's a little incomplete study of fundamentals. Right? Now, that's quite an important piece to understand. There are certain companies where profits is not a complete study of fundamentals, because beyond profits, there are a few other drivers of fundamentals, and hence free cash flows is the true study. Now, let's come to how this is relevant for Marcellus's CCP portfolio companies. So first and foremost, our portfolio companies, they try to derive their competitive advantages by having in-house manufacturing, in-house distribution, and deriving efficiencies on both these fronts, manufacturing side and distribution side. Let me give you some examples. So Nestle can easily outsource its manufacturing, just like many FMCG companies outsource their manufacturing. But Nestle has decided to do CapEx and go on in-house manufacturing model rather than asking a contract manufacturer all the time to manufacture Maggies and infant formula milk powders and chocolates, etc. for Nestle, right? What this company is doing is, by keeping manufacturing in-house, it is investing in technology to build state-of-the-art manufacturing plants, which an outsourced contractual manufacturer cannot actually build. And by doing this, they are sweating their assets harder because of higher productivity per unit capex, higher productivity per unit asset on the balance sheet, right? Now, this leads to expansion in asset turns without leading to increase in profit margins, right? And hence it drives free cash flows higher. Another example, Page Industries, interestingly, Page Industries between 2011 and 2016, if you look at Page Industries' annual report, they talk about their capacity and they talk about their labor workforce, right? Capacity utilization. When you take a ratio of the two and you see the volume of innerwear manufactured by Page per unit labor, that number has gone up at a rate of 6% CAGR, right? Notice volume per unit labor going up at 6% CAGR for those 5 years. Why don't I talk about beyond 2016? Unfortunately, some of the data stopped getting disclosed on a like-for-like basis, but that number has actually gone up further. The productivity measure of Page Industries' in-house manufacturing has increased to ensure that they are not increasing their labor workforce as much as they are increasing their output, right? Now, that increase in productivity obviously then means they don't have to set up a 30% expansion in capacity for a 30% growth in volume, right? And hence their assets get sweat harder. So many examples. Similarly, at the front end, in Asian Paints has got in-house distribution. Asian Paints doesn't use distributors and wholesalers. It has got in-house distribution. But by making the distribution in-house, Asian Paints is then saying, I will now compress working capital cycles, and that will be my competitive advantage versus competitors. It will drive my free cash flows further, and hence not so much just the margins, but free cash flows drive the value of our portfolio companies, right? So that's one reason why this concept of what happens between earnings growth and free cash flow growth is important. The second reason, our portfolio companies, they avoid price hikes to suffocate competition, right? Dr. Lal PathLabs in the last 5 years has not hiked prices for its diagnostic tests. Asian Paints in the last 20 years has done, I think, 2.5–3% annual average price increase. Relaxo Footwear, which is part of our coverage and in some of our other portfolios, has avoided price hikes for the past 4 years. Avoiding price hikes, right, means that you are playing the volume game. Now, if you are playing the volume game, obviously you're making the product more and more affordable, and hence more customers are coming. That is driving your volume growth, right? But this moves your competitive advantage towards managing scale of volume with in-house manufacturing compared to somebody else who's just trying to play premiumization game, right? Many companies say we'll premiumize our product portfolio, and that is how we will grow our profits and hence free cash flows. Here, these companies are saying we will play the volume game, and volume game will mean we have to play on the balance sheet productivity side more to provide growth in free cash flows than just expanding our operating margins, right? So that's a second reason why, in particular for our portfolio, where companies don't want to increase product prices so much, the operating margin is not really the driver. In many cases, even revenue growth, right, is not really the biggest driver of free cash flows. It's beyond profits. Now, the last piece, which is actually very important, is that as I was talking about more recently, tech investments have been accelerated by many of our portfolio companies. So Asian Paints has put in auto replenishment systems, right? Over the last several decades, Page Industries has put in auto replenishment systems. Over the last several decades, Asian Paints has got demand forecasting driving an improvement in its working capital turnover, so on and so forth, right? The productivity improvements through tech investments, right, are a massive driver of free cash flows. Now, this was not possible till 10-15 years ago, when tech was of a limited degree available to these companies, right? Till 10-15 years ago, there were some processes, there were a few systems, but what has happened over the last 10-15 years through machine learning, through AI, through robotics, right? Many parts of the value chain of a great quality business can see tech investments, which were not even possible till 10-20 years ago, right? And this combination of these three factors is largely the reason why in Marcellus CCP portfolio companies, you see free cash flows being driven more by working capital compression and asset turns than just by, say, revenue growth and profit margin expansion, right? Now, let's see the quantified impact of this. So this table has got two parts to it. You've got the FCF CAGR for our portfolio companies over the last 5 years, 10 years, 15 years. And then you've got the earnings CAGR, the profit after tax CAGR, right? Over the last same 5-year, 10-year, and 15-year period. And then for the same time period, compare FCF with earnings. So let's compare the last 5 years. On average, our portfolio companies have delivered 25% compounding in free cash flows versus their earnings compounding of 14. The 11 to 21, there has been a 27% compounding of free cash flows versus earnings compounding of 16. 6 to 21, 32 versus 20. There has been a good 10-11% gap between profit after tax rate of compounding and free cash flow compounding. Value of any company is the present value of future cash flows. If cash flows are consistently being driven by different set of drivers than earnings, then cash flows are the ones which define the value compounding, not so much earnings. And hence, if an investor just stops short at this 20% CAGR or 16% CAGR of profit after tax compounding, that's a little incomplete an exercise to understand what really the fundamental growth has been for this portfolio, right? So that's hardcore data. Now, as a result, in order to then say why is it not so easy for everybody to then switch over from say the P&L to cash flow statement so easily, right? So let's understand the difficulty in forecasting free cash flows for some types of investors. So to begin with, as I summarized, free cash flows for a CCP can be driven by revenue growth, partly by operating margin expansion, then partly by working capital cycle compression and increase in asset turn. When it comes to forecasting these four factors, the first layer of difficulty comes in forecasting improvement in working capital cycle and asset turns, right? Because it's a little more tangible to forecast volume growth and margin expansion. Why is it more tangible? I mean, volume growth, the maths can be done by saying that, look, this is the size of the customer base. This is the current market share. Let me expect the customer base to grow at a certain rate. Let me expect the market share to grow from here to here. And hence, this is the growth in volume that I expect my portfolio company to deliver. That's a little more tangible science that can be done intuitively, right? When it comes to margin expansion, you go and ask a management team, sir, what sort of margin cost optimization initiatives are you taking? They might tell you about it, and you come back and say that, look, the peer, a competitor is running freight cost as a percentage of sales at this level. I can also see my portfolio company going to the same level, so on and so forth. There's some way to do that. When it comes to working capital cycles, right? You have to actually not look at such types of, say, what is the customer doing, what sort of cost saving initiatives. You have to actually look at the investments to collect money from debtors, from your customers faster, investments to reduce inventory in your warehouses of raw material, inventory in your warehouses of finished goods more and more, right? And hence run a much leaner working capital cycle. Those investments have to be tracked. In order to track those investments, one, you need to assess the mindset towards generating higher working capital turnover for the company through tech investment. Does the company really have the mindset to invest in tech? Have they really appointed an SAP recently? Have they invested in Salesforce automation? Have they invested in manufacturing automation? If they have, then to what degree can they further automate this? Is there further scope to reduce inventory days? Is there further scope to collect faster, right? That is a different type of, I would say, understanding of the business. And hence it adds on to just the revenue growth understanding and margin understanding, right? So that's something worth doing. And then similarly for asset turn piece, and hence it's a longer research process, which then might not be what every investor wants to go through. The second reason why it is difficult is it requires a different degree of patience. Pidilite acquired Araldite last year. Free cash flows went down to 0 in FY21, right? Because it used internal accruals to pay for that acquisition. Now, if somebody then says, well, had I looked at profits wouldn't have gone down to 0, just like had I looked at book value wouldn't have gone down to 0. Here, free cash flows are going down to 0. I don't know what to make of it. Has the business become weak, or is this temporary, right? As a result, the volatility in free cash flows, which is a lot higher than volatility in profits in the short term, needs a lot more patience and sort of granularity of understanding to see whether you should be worried about a free cash flow decline or you should not, whether you should be happy about a free cash flow expansion or you should not, right? So that volatility, many companies do lumpy capex, right? Paints is a chemical company. Most paint companies, they do capex once in 3-4 years. And when they do that capex, it is a significant increase in their assets because it's a lumpy capex. That compresses the asset turn for a couple of years. Because it compresses asset turn, free cash flows, they go down, right? And hence, you need to factor in a lot longer time horizon in your research process on this fundamental parameter in order to capture it adequately. So those are the few challenges in forecasting free cash flows. Provided an investor is up for it, then there are companies whose business models are evolving away from just margin expansion on the P&L, and hence they need to be understood differently, right? So that's about the theory. Now coming to practice. So this chart talks about Asian Paints. Asian Paints is last 15 years of free cash flow compounding broken into various constituents. So the gray bar at the extreme right is the FCF compounding Asian Paints has delivered 27% in the last 15 years. And that 27% has been built basis only 14% sales growth, 4% margin expansion. This margin expansion is a combination of reduction in say freight costs, premiumization of the portfolio and hence gross margins, change in formulation of their raw materials and manufacturing processes in order to expand gross margins, so on and so forth. That's the operating margin expansion, which is added 4% on top, and then starts the stuff beyond profit after tax. First of all, working capital reduction, right? Asian Paints has reduced their working capital by increasing inventory turns in their supply chain. That inventory turn increase has been done by sort of getting closer to the end customer with depots, which work with very lean inventories because they can forecast inventories better than they used to 15 years ago. And that better forecast of inventory means they don't sit on unutilized inventories for as long as they used to 15 years ago. That incremental improvement has led to a sort of 1% CAGR added to the cash flow buildup. And then you can see this 4%, which is decrease in capex to CFO, in a way, increase in asset turns, right? This is a very asset heavy business, right? Paint manufacturing being chemicals is a very asset heavy business. Asset turns are barely 2.5 times, right? Asian Paints has invested significantly in automation of manufacturing processes, right? You read any partner of technology for Asian Paints sitting in the US, go to their website, they would have a blog quantifying that we helped Asian Paints increase productivity by 7%. We helped Asian Paints deliver more volume on the same machine in the manufacturing plant because of this tech investment. Those types of initiatives, they have led to the extra 4% and hence the 27%. Again, if somebody looks at only sales CAGR and operating margin expansion, that's only 18% in the last 15 years, which has not driven the share price entirely. Share price has been driven more by the 27% FCF CAGR, right? Look at sorry, the bar is not allowing me to see the name. One second. Yeah, you look at Titan. Yeah, you look at Titan's free cash flow buildup. 20% has been the sales growth. Margins have not expanded much. I mean, although more recently they've compressed, so there's a point-to-point problem here. Margins is not where Titan has made the bulk of the money. Working capital, massive reduction, right? How has this reduction happened? One, the nature of the business itself has changed. Their debtor days have reduced. I think they used to have some 25, 30 debtor days till 15 years ago. That's gone down to only 10 debtor days today because the business model has changed. It used to be watches selling to distributors, selling to wholesalers. It is now jewelry, right? The proportion of jewelry has increased significantly. And in jewelry, you are selling to the end customer through your own retail stores. There is no credit you are giving to the customer, right? So the debtor days in a way have reduced because of the change in the business model. On top of it, they have also changed the tech which runs inventory management across the stores, right? So inventory levels are being used much more efficiently now across the network of Tanishq stores, and hence you see working capital reduction there. There's an increase in asset turns, right here. I mean, this is a little bit of a asset-light model where they've outsourced large part of the manufacturing, and there is an increase in asset turns by doing more and more tech investments in their backend, right? That has delivered a 29%. Again, a 10% delta between profits and FCF, right? If this 10% is not understood fully well, it's an incomplete understanding of Titan, right? When it comes to Page Industries, sales CAGR of 25, right? Working capital has reduced. Page's inventory days till 3 years ago were as high as, I think, 105 or 110. Now they are as low as 80, right? That inventory day drop, right, is because of ARS. It's because of more such tech investment at the front end, right? On the productivity side, I previously gave you the data, 6% increase in volume per unit labor over a period of last decade is a massive driver of productivity increase, which feeds into asset turns as well, right? So when you look at 35% of Page, it is not really just the sales CAGR and profit CAGR. Sales and profit is only 25. There's a 10% beyond that which you need to understand. So that's really on the free cash flows. Very quickly, just covering up the current progression of fundamentals of our portfolio companies. This table shows you how the second quarter has been for our portfolio. Two ways to look at it. One is compare it against last year. Now, in some ways, last year was a year of recovery. Last year, September quarter was a quarter of recovery for many of our portfolio companies. So it wasn't such a low base, but for some companies, it was still a low base, like for a Titan, right? A Titan 65% growth on a year-on-year basis is not the normal growth run rate for this business. So there's a little bit of misrepresentation when you compare year-on-year numbers, and hence it's actually better to look at 2 years, 2-year CAGR, right? When you look at 2-year CAGRs, there's a very healthy recovery in the sales growth rates. Now this is getting back to the 15 to 20% ballpark of our portfolio sales growth that we expect in the long term, that they've delivered in the past, right? Remember, 2 years ago, there was no COVID. 2 years ago, there was no abnormality in the base. Being able to grow sales over the last 2 years by 15, 20, in some cases 25%, Titan 27%, is a remarkable outcome. What is it reflective of? First and foremost, it is reflective of market share gains, right? This is what is driving the sales growth CAGR for our portfolio companies. Why? Because in particular, unorganized players, and to a certain extent, even weaker organized competitors, have found it difficult to even survive through the logistical challenges thrown up by COVID disruption, right? So COVID has led to massive increase in shift from unorg to org. Within organized, Asian Paints is the fastest growing paint company. Dr. Lal PathLabs, last quarter, in fact, Dr. Lal PathLabs is non-COVID business. I think it went up by some mid-20s on a year-on-year basis, whereas that for a metropolis, it went up by only 5%, right? So in that regard, there's a massive, Dr. Lal was high teens non-COVID growth in revenues compared to 5% for metropolis, right? So there's market share gain, not just from unorganized to organized. There's also market share gain amongst the organized players, from weaker organized to stronger organized. That's one part of benefit that COVID has had, which we can already see in our sales growth rates. Then there's a second part which is yet to start playing out. This is that over the last 18 months or so, there have been many capital allocation initiatives taken by our portfolio companies that are yet to contribute to their profit growth and free cash flow growth, but they will certainly contribute in a meaningful manner over the next 2-3 years. For example, Dr. Lal PathLabs acquired Suburban Diagnostics, right? It acquired Suburban at an EV/EBITDA multiple, which is, I think, 1/3 or 1/4 of Dr. Lal's own EV/EBITDA multiple. And that too when EBITDA of Suburban is suppressed because of relative inefficiencies in Suburban's business model compared to Dr. Lal's business model. Dr. Lal eventually will see this EBITDA inefficiencies go away, and hence there will be actually significant synergies coming out of it. Secondly, the Suburban acquisition helps expand Dr. Lal's presence into West and South India. And since healthcare, whether it be hospitals or diagnostics, it's a very regional subject. Right? It's very difficult to actually organically expand the brand of the trust of healthcare geographically. This is not about advertising with Madhuri Dixit on the TV channel with a soap or a detergent and letting the brand recall do its magic across geographical expansion, right? It doesn't happen like that in healthcare. That's one of the biggest reasons why organic expansion had been slow for Dr. Lal, and Suburban's acquisition significantly enhances the prospects for expansion in West and South, starting with West with Suburban, and Dr. Lal is setting up several labs and collection centers in the parts of Bangalore and South as well. This is yet to get factored into the revenue growth, the profit growth, the free cash flow growth that you see Dr. Lal report. It's a capital allocation initiative that maybe, had COVID not happened, maybe it might have been a little delayed. Similarly, Pidilite acquiring Araldite, right? An acquisition last year. Araldite, a 36-40% EBITDA margin company, acquired by Pidilite with internal cash, helps them dominate epoxy adhesives, which is actually a very large sector of adhesives industry that Pidilite did not dominate so far, right? And massive synergies, given that Pidilite already had a little inefficient presence in that space. And now Araldite will help drive efficiencies there. Again, a very modest price paid. I don't know if Huntsman would have been willing had COVID not happened to sell at this price and at this time. Dr. Lal PathLabs investing into tech for collection of samples from households, right? Home sample collection, as they call it. Massive tech investments to do that got accelerated over the last 18 months because people didn't want to step out of their homes and walk into labs to give their samples. And hence there was an opportunity where the customer was willing to accept a new capital initiative that Dr. Lal is capable to deliver on. Likewise, the Page Industries, right? Massive tech investments to drive around AIS for distributors to expand their channel, right? Page Industries' channel has almost doubled in the last 18 months. It has almost doubled in the last 18 months in terms of the number of MBOs, the number of multi-brand outlets that Page reaches out to. And this again is to a large extent because those multi-brand outlets which would have otherwise been happy selling unorganized in a way, they didn't have a choice. They had to onboard Jockey, and hence Jockey got to sell products to customers which otherwise would have been delayed by 3, 4, 5 years, right? Now, these are all examples of capital allocation initiatives that otherwise might have taken longer, have been playing out now, and the rewards will be reflected in future. When it comes to tech investments, some of it I already talked about, right? Asian Paints doing home decor, right? As a tech-based, labor-oriented service. Dr. Lal doing this, Page doing this, Titan investing in tech, Carrot Lane taking so much acceptance from customers, getting so much acceptance from customers, right? All of this is happening because the ecosystem of every company is adopting to tech a lot faster than what they would have without COVID, right? So COVID is actually a massive catalyst for tech adoption. And then the last piece is raw material inflation. It's a massive blessing in disguise. Some of you might have a question around this. Raw material inflation means companies with high pricing power can more easily pass on the cost inflation to the customers compared to their competitors. That's point number one. Secondly, companies which drive more operating efficiencies through manufacturing processes and various other parts of the business can actually avoid hiking prices to a significant extent, even though their raw material costs have gone up. That way, they suffocate competition more in a raw material inflationary environment because competition cannot derive similar degrees of operating efficiencies, and competition cannot hike prices beyond what the market leader is hiking prices by, right? So that's one way to force the competition to take margin compression when our portfolio companies will not be taking such a margin compression, right? So combination of these four things in a way means that having gone through the disruptions of COVID and its aftermath over the last 18 months, the fundamentals of our portfolio companies are actually much better positioned to deliver healthier free cash flow growth over the next 2 to 4 years than perhaps it might have been without some of these disruptions happening. So I'll stop there and maybe pass it back to Pramod. Pramod, if you can moderate questions, I can answer. We can answer, Saurabh and I.
Sure. Thanks, Rakshit. There's already plenty of questions out there. For those who want to ask more questions, feel free to enter it in the Q&A box at the bottom. So I'll start off with the topic at hand. There are 3 general categories of questions that have come in. One related to the free cash flow topic that we've been discussing. There are some nuanced questions I think worth delving deeper into. The second category is, of course, on the portfolio and specific stocks and so on. We'll definitely take that up. The third is sort of FAQs. We've answered questions around timing the market, sitting on cash, underperformance in the short term, so on and so forth. If time permits, we'll try and do a quick rejig of those. But otherwise, if you access our past webinars, you'll find answers to them. Otherwise, we'll reach out to you in person. So I'll start off with questions relevant to the topic in question. I think the most sensible question I found was, of all these four drivers, clearly there's a limit to working capital turnover expansion, asset turns expansion, right? So the working capital cycle can become negative, of course, but isn't revenue growth the all powerful driver of free cash flows eventually? How much efficiencies can an Asian Paints deliver? As we've seen, working capital crunching has contributed to maybe increasing the free cash flow compounding by 1% in the last 15 years. So therefore, is it worth, or rather, how much more scope do CCP companies have on number 3 and number 4?
Right. So look, there's certainly going to be a limit to every single initiative, right? But if you take series of initiatives, then the limits can be pushed further in time, right? So working capital cycle to begin with itself will have several components to it. As you keep building your business further, right, there will be more and more opportunities to compress working capital cycle for incremental new businesses to begin with, right? So yes, working capital itself cannot provide maybe a 10% CAGR for the next 30, 40 years for a business, because once it goes down to maybe 0 or negative, there might not be a significant further scope left to compress working capital. But having said that, as we've seen with tech as a subject, right? A tech investment based on compressed working capital cycles can actually pump up volume growth further, right? So a large part of Asian Paints' revenue growth that you've seen, right, has come from volume growth. That volume growth has come because Asian Paints has avoided price hikes. Why has it avoided price hikes? Because it could compress working capital cycle. So working capital cycle is not a standalone factor, right? If you compress working capital cycles by 2% CAGR, it actually helps you also to drive market shares higher. It feeds into volume growth. Once volume growth goes up, interestingly, provided you are running your manufacturing very efficiently, asset turns also go up, right? So it's kind of a leveraged model you can think of, and hence these are all interconnected drivers. Now, the more system process efficiency oriented a business becomes incrementally, there is scope for either driving just the volumes using the efficiencies, or volumes plus those other 3 factors to drive working capital. Now, when it comes to taking these examples, right, it's not that 15 years ago, Asian Paints hadn't yet gone through a journey of working capital cycle compression, right? If you look at Asian Paints' fundamentals in the 1980s when it got listed, from there to 2006, its working capital cycle had almost halved. Still, it delivered another layer of working capital cycle efficiencies, right? So at any point of time, you would get a sense that, look, historically, already they've squeezed so much. But provided a company is always with a mindset of ensuring that either you derive volume growth through efficiencies, or you just do PAT plus through efficiencies, I think there's a long runway before we talk about saturation in this concept.
So Rakshit, just stay with this slide, and I think we can do 2 quick examples of why the nature of technology, the nature of changes in India has fundamentally changed the answer to this beautiful question. I think whoever asked the question, a lot of credit, because I think this question goes to the heart of why investing today in India is very different from what it was 20 years ago. So let's take 2 quick examples to understand how the nature of winning companies has altered in the last 20 years. So if you look at, say, Dr. Lal Path Labs, I don't have the numbers to hand, but I'll try to give you a rough sense of how this slide would work. This slide is for Asian Paints, obviously, but we'll quickly apply it for someone like Dr. Lal Path Labs. So if you look at Dr. Lal Path Labs over the last 10 years, a decade back, this was a 20-25% return on invested capital business. Today, it's Rakshit more like what, 120-125%.
Yeah, on invested capital, yes.
So in 10 years, this Path Lab company, and it's not even a large cap yet, it's what, $4 billion market cap, still only 5-6% market share. In the space of 10 years, Dr. Lal's return on invested capital has gone from 25 to 125, right? Now that's been driven by different aspects of this. And the reason I'm going to lay out the different aspects is to give you a sense of how these things interplay to change the industry, change the market size for the company. So step one was, they said, we're just in NCR. Why are we just in NCR? Let's go to UP, Jharkhand, Bengal, Madhya Pradesh, Maharashtra, and so on. Right. So the sales CAGR figure was accelerated beyond organic growth in the NCR area. They spread their wings both through franchisee expansion, franchisee signups, and acquisitions. Sales CAGR, Rakshit, 10-year sales CAGR, what, 16-17%?
10 year is more like early 20s actually.
So the sales CAGR itself was pushed up. 10 years ago, it was a very small company, right? And they basically gobbled up market share and gobbled up smaller players, right? So you push the sales CAGR to 20 because you've got an efficient management team which can acquire, integrate seamlessly smaller path labs. Secondly, they started introducing higher margin tests. So the higher EBITDA margin tests. So genomics, allergy tests, cancer-related executive health checkup. So your operating margin expansion, the second lever, fires into life. Today, Dr. Lal offers, I think, more tests than anybody else in the country, and more high-value tests than anybody else in the country. So you're adding, beyond the sales wala skyscraper, you're adding to the operating margin skyscraper. Thirdly, somewhere 6-7 years ago, they bought SAP into play. They used SAP to crush working capital cycle, right? Classic part of Rakshit's flywheel, crush the working capital cycle. Other people can also buy SAP, but the smarter the management team, the more efficient the application of technology. So working capital cycle today, Rakshit, was 0 days working capital cycle, right?
Yeah, very low.
Decade ago would have been what? 10 years ago, working capital kitna hoga?
Yeah, let me actually project this, Saurabh, and then you can talk. Yeah, this is Dr. Lal Path Labs.
So working capital cycle when the benefits actually are a little bit more modest than I thought, but you can see the left.
This is only 5 years, Saurabh.
Yeah. So thoda sa upar kar do, 15 to 20. There's a working capital cycle benefit. Last 5 years mein nahi hua. Then you go to the tax rate. The tax rate they can't control, but the government, as you know, cut the tax rate, so unko bhi fayda hua. Right. Then we go to the capex, right? Capex to CFO, which is basically asset turns. How efficiently can you sweat assets, right? So again, this company used technology better than others to locate their testing centers better, to drive better footfalls per test center, move the business to home collection model and to mobile. The more you move the business to home collection model and mobile, actually you get a double benefit. Aapko operating margin mein benefit milta hai, and your asset turns benefit, right? And you end up with this business doing free cash flow compounding in the last 5 years of 24%, right? Now, why is this so powerful? If this business generates so much cash, it opens up 2 sources of growth for us. First source of growth. Obviously, this company has tons of cash on the balance sheet. It can do lots more suburbans. They can go and take out the best operators, the largest regional operators, because they've got cash. Where did the cash come from? The cash came from squeezing out working capital efficiencies, squeezing out cost efficiencies, sweating assets harder, right? So first benefit to you and me, higher growth. We'll get higher growth from the free cash flow compounding, because the free cash flow compounding can be used to acquire more suburbans and consolidate the industry. Remember, 85% of Path Lab is in the hand of mom and pop labs, right? Dusra. Remember, Rakshit said Dr. Lal Path Lab hasn't taken a price hike in, I think, 5 or 6 years, right? Typically, like all other great compounders, this guy is suffocating competition, right? His price hikes are 0 or 1%, perhaps more like 0% in a country where CPI inflation is 5%. So Dr. Lal is making the product cheaper with each passing year. When you make a product cheaper, you expand the market, right? So the second source of growth for you and me is you expand the market by making the product cheaper in real terms. Asian Paints, very similar, right? So this flywheel, it's a flywheel. It's not a static chart. Obviously, to help you visualize it, Rakshit has demonstrated to you as a static chart, but it's a flywheel. These components interplay. The more you are able to use technology to drive your operating margins, your working capital, your asset turns, the more cash you have, the less price hikes you have to take, the more you expand the market. Secondly, the more cash you have, the more growth you can finance. And you and I therefore compound at 25, 26% for a long time. The inability of 99% of CEOs to get their head around this, and then the inability of 99% of CEOs to do the amount of mehnat, the amount of work required to make this flywheel work is what results in no more than 20, 30 companies being able to make 10x in 10 years, 100x in 20 years, 1000x in 30 years for us. But this process, this flywheel is a limitless flywheel. It's an infinite flywheel. That's why I suppose this is called the infinite game. You can do this if Dr. Lal or Asian Paints or Pidilite, if they keep getting this quality of management, they can do this for a very, very, very long time, and certainly longer than your Rakshit and my careers.
Great. So one of the questions is, if FCF is so important, fair enough, P is irrelevant. Why not use, say, a free cash flow yield or a price to free cash flow? Related to that is a question around volatility of FCF given the capex cycles. I guess the two answer themselves, but your thoughts on that, Rakshit?
Yeah, no, as you rightly said, the two answer themselves. So if you take FCF yield, right, the problem will be let's say price to FCF in a way is what you try to do. The denominator in a price to FCF will be a 1 year number. That 1 year number will oscillate, right?
But I think that we can help the Janta deal with. No, why don't we go to your classical slide, that free cash flow and share price CAGR, because I think that will answer exactly this question, right? The free cash flow is share price wala, the one that you use in the CCP ka main deck, right?
I'll project that.
So super question. So whoever's asking this, right, you can actually use this very well. You just have to deal with the 1 year problem that Rakshit mentioned. So if you have free cash flow in the numerator, make it a 5 year rolling average, put the share price also on rolling average, and you'll see there is actually no inflation in the FCF yield. Now that you can see here. So for example, if you take whichever time horizon, you take 20 years free cash flow growth, 20 year share price growth will be identical. You take last 10 years share price growth, last 10 years free cash flow growth will be identical. In fact, if you take the last 5 years share price growth and free cash flow, that's also identical. What that's telling you is that the free cash flow yield is not rising, and that's why it's again super question. And I think everybody out there, strongly urge you do this. Just make sure you deal with the 1 year issue, because Rakshit has rightly said free cash flow on a year to year basis volatile ho sakta hai. So take a 5 year rolling average on the free cash flow, do the same on the share price, and you will see there's actually no inflation. There's no kind of unsustainable valuation. The usual nonsense point that people make is P multiple chad gaya hai. Price to free cash flow hasn't risen, and you can see in front of you visual proof of that. Whichever horizon you take, these companies are growing free cash flow and share price at the same rate.
I guess the more important question is, these tech initiatives and stuff are in the here and now, when we can see them and appreciate them, and perhaps draw some from our experience how effective these initiatives will be. But given our view of the value of the companies is in the free cash flows to perpetuity, how do you make a long-term call? You're saying that companies generating 20% free cash flow growth for the next 20 years is worth a lot. But how do you make that call that these sort of efficiency gains will sustain over that long term? So, Rakshit, if you can bring up the longevity framework and talk people through it, it's perhaps the core of what we do.
Yeah. So how do you assess the sustainability of these tech initiatives? How do you assess the sustainability of free cash flows? There is one harder way to do it, hard as in tangible way. One tangible way to do it, which is about capital allocation, where all has the company invested more recently. And then there is a DNA oriented way to do it, which is a softer aspect. Is tech part of the DNA? efficiency part of the DNA is the strategy of the management sound? Is the board alive and awake to the evolutions that the business has to go through, right? So those are two different subjects. On the capital allocation piece, the first bit, which is doing more of the same in a better way over the next 2, 3, 4 years. That's not a 20-year view, but that's to measure investments made in the last couple of years, let's say, to drive the next 3 to 5 years of free cash flow compounding. The 20-year view starts emerging here, where you first of all say, okay, let me see if this company is going to expand the canvas, which means the tech initiatives of Asian Paints today will not be limited to paint. Tomorrow they will also be in waterproofing. Then they will also go into, God knows, wallpapers or labor-oriented services that they're offering. For a Dr. Lal Path Labs, it will not just be around turnaround time of the report. It will also be tech initiatives to collect samples from home more efficiently. Tomorrow it might be tech initiatives to offer consultancy maybe on tech. Tomorrow it might be genetics. It might be something else, right? A business needs to keep adding to the revenue growth drivers. That will keep increasing the number of avenues where tech initiatives can be made, right? Then comes the most important bit for the very long term, which is you need to see how the business is trying to disrupt itself and its own industry to make its business model difficult to replicate. Many a times this will be through tech. Sometimes it might not be through tech. But this piece provides the sustainability to free cash flows, whether it be via revenue growth sustainability, profit sustainability, or working capital and asset turns. But free cash flow sustainability at a very healthy rate has to be there from these initiatives. And then comes understanding the thought process of the management. If tech is part of the DNA of a company, we will never know what tech investment the company will do in 2025. But if tech is part of the DNA, we will know that there is a high probability that the company will do prudent tech investments in 2025, whatever shape or form they might be, right? That is the understanding on the softer side of the business that we try to establish. Beyond that, obviously, we don't know specifics of how the business will be running 10 years out, but we want to understand the DNA. Provided the DNA is there, sustainability will come. Pramod, you're on mute.
So very pertinent question, or the very topical question is related to the new age tech companies. Obviously, these guys haven't demonstrated any free cash flow generation. Forget about free cash flow generation. Most of them haven't generated a profit. Having said that, that shouldn't be the reason why we rule out those companies. Those companies might still have potential to generate significant free cash flows in the future. Case in point being, say, Amazon. Amazon did not generate free cash flows for a long time. How do you distinguish? In hindsight, we can see Amazon was actually generating free cash flows in its core business. It was reinvesting those free cash flows to the extent that reinvestment rates were perhaps north of 100%. How can we sit here and assess if these new age tech companies fall into the Amazon basket or in general are a basket case by themselves?
Yeah, no, good question. Very relevant, and this would actually apply to all companies in our existing portfolio as well, not just to the new age companies, because our existing portfolio companies are also making certain tech investments, which we want to ensure are not capital misallocation. Now, how do we do this? One is, well, to begin with, assessing the discipline of capital allocation that a business follows, right, is important for us to generate that confidence in. So in the case of an Amazon, as Pramod mentioned, one business was generating a lot of free cash, and it was pumping that into another business, because of which the overall firm was not generating free cash. That's the way it evolved. Now, when you look at, say, many of the businesses in which we are invested, right? So take, for instance, the example of an Astral Poly. It's in some of our portfolio companies. Take the example of a Relaxo. It used to be in Consistent Compounders. Still, it is part of some of our other portfolios. These types of companies, Relaxo till 2012-13, Astral Poly even today, they are not generating any free cash flow. But they are, when you break down their business into components, the core is generating significant amount of free cash flow, and reinvestment is happening in areas where there is a way in which you can understand and get convinced about the prudence of those capital investments, which are leading to suppression in free cash flow today, but are creating massive sources of free cash generation into the future, right? That is the process which you have to ascertain. The understanding of this process means building conviction around whether the business can get disrupted or not tomorrow, whether the business has pricing power today or not, whether the business is running a succession planning as an institution, right? Execution is happening in a decentralized manner or not. When you assess pricing power, institution, and let's say alive and awake to possible risks of disruption, on these parameters, when you assess some of the new age companies, right? That's where actually we don't have enough number of data points yet which convince us. In fact, the data that we are currently seeing is not convincing us that how can one particular tech company retain its market share and profitability if 5 years down the line, say one of the largest corporate conglomerates in India offers half-priced offerings, half-price services, half-price products against this company. Will they be able to retain market share or not? That conviction is not coming to us yet, but if it does come, then there is nothing stopping us from considering investing in new age tech, provided we have the confidence on their capital allocation discipline, their institutional constructs, and then historical demonstration of generating free cash flow from one place and pumping it into another place to provide for long-term free cash generation for the overall business.
Right. So I guess what you're saying is there's nothing right or wrong about it. It just doesn't fit into our philosophy, where we look for a significant amount of conviction, which in turn reduces the risk of these investments failing. So for another investor with another philosophy, it might make sense. So it's up to you. So we're talking in the context of consistent compounding here. On free cash flow, given that the free cash flow concept doesn't apply to financials, how should one look at for similar drivers of value creation through tech initiatives and so on?
Yeah, so for financial services, in particular lenders, for instance, profit after tax actually captures everything that the lender does around tech, right? So Bajaj Finance actually is fintech. Whatever initiatives Bajaj Finance takes in future, they will be part of one of the revenue generating line items or one of the cost optimizing line items, and hence they will be part of the P&L. At the same time, they will be part of returns on assets and hence returns on equity, right? So for a lender, for a financial services company, EPS, in fact, not only profit after tax, because these companies also raise capital, so there is dilution and hence need to do per share rather than rupees crore profits. So EPS captures the benefits of tech if these companies deploy tech.
And Pro, the similar thing that Rakshit's doing with free cash flow, ROE greater than cost of equity, performs the same function. So in a way, the surplus that a lender creates is ROE in excess of cost of equity, and a very similar set of drivers. The DuPont for a bank around operating margin, around leverage, then the various drivers of operating margin will give very similar outcomes. Is that because the bank doesn't have free cash flow, you focus on ROE as an ROE in excess of cost of funds as the most critical metric, and it's a very similar dynamic. So if you find a bank or even an insurer where return on equity doesn't exceed cost of equity, then one shouldn't really rationally invest in that. But nobody told that to lots of our fund managers who consistently buy banks where return on equity is below cost of equity.
So I think we have covered it in one of our Kings of Capital newsletters, the DuPont analysis using net interest margins and then operating costs and credit costs and then finally financial leverage, all of which involves usage of technology. For example, usage of technology for reducing credit costs and NPAs is akin to what Asian Paints would do to improve its free cash flow from sales growth and earnings growth. So I would urge you to go through some of our KCP newsletters, or certainly in our next KCP webinar, we'll make sure we cover that aspect as well. Now moving on to some specifics as a takeoff. Clearly, the question is at the portfolio level, you're right, the FCF compounding and the share price compounding look similar. Yes, we are portfolio managers by definition, so that's the reason we construct portfolios and not just invest in single stocks. But Nestle stands out here. Irrespective of which period you take, Nestle's FCF compounding has been 14-15%. Is that something that we'll be happy with, or is there a brighter view that we're taking on Nestle going forward on this account that we still retain it in the portfolio?
Yeah, so that's a very good question, well spotted. So Nestle, after Suresh Narayanan has come in, has been a kind of a different business compared to what it was in our eyes before Suresh Narayanan came in. Prior to Suresh Narayanan, the focus on efficiencies wasn't as much, if at all, in Nestle's case, as it has been after he has come in. And the focus on volume growth wasn't as much. There was more focus on just hiking prices, and that was actually having an adverse impact, right? That's one piece. As a result, when you actually look at, say, the last 3 years or 4 years, that's a very different picture compared to the last 5 years, right? Last 3 years, free cash flow profit as well as free cash flow CAGR is in the high 20s. Right, last 5 years has been 15, but yes, before 2016, Nestle's sort of degree of difference between PAT and free cash flow wasn't as great as what it has been in the last 3-4 years. So yeah, it's a little bit of a point-to-point problem when you compare, say, FY16 to 21 for Nestle with other companies. At the same time, very recently they did a capex, right? They did a capex, and Nestle also does a little bit of lumpy capex. So not only was the base not representative of the kind of efficiencies that Nestle has derived subsequently, the numerator in computing the CAGR has also been suppressed more recently, which is also the reason why, as I said, the profit after tax actually has compounded at 28% even over a 4-year period. Right, but their free cash flows, if you look at a 5-year period, it's a lower number. So that's only optical. Otherwise, Nestle is also in the same bracket. They are expanding the margins by 150 to 200 basis points each year. Incremental efficiencies. The new capacities that are coming up have got by an order of 3 to 4 lower number of workforce required for the same amount of capacity. The automation is of a different degree altogether. So we are quite comfortable there.
Fair enough. So just moving on to the portfolio update part of the webinar. So obviously the elephant in the room is the big change that we made a couple of months ago, which is the exit of Relaxo and the entry of TCS. Can you walk clients through the thought process here, particularly saying, why not retain Relaxo and still add TCS as well? So your thoughts.
Folks, I'll just take your leave at that point. Thank you very much for your time. Thanks.
Saurabh, just a lot of people are asking one question. When is Marcellus's next book due?
I think as soon as we can convince our better halves that we should be allowed to write another book. In fact, there was a meeting today that's been postponed for a month by a month as to whether we work on the next book or whether our wives throw us out of the house. So I think I'll let Rakshit go back to more prosaic matters. Thanks, Pramod. Thank you.
Thanks.
Yeah. So let me first quickly cover up specifics of TCS, and then highlight why not add it instead of replace Relaxo with TCS. So TCS has been part of many of our portfolios for more than a couple of years, not consistent compounders, but some of our other portfolios. And it's a company that has always been in the coverage universe of consistent compounders. We've written about it extensively in our books, whether it be Diamonds in the Dust or Coffee Can Investing, etc. We have really liked TCS for the competitive advantages that it has built around managing manpower, managing lower attrition rates, managing execution with its clients at a scalable level in a way much better than its competitors, right? So that's been the core strength. What has happened is through the last 2-3 years, in particular through COVID, right, the importance of this strength of TCS has increased by leaps and bounds. How has it increased? So till 3 or 4 years ago, the rate at which applications of a corporate were moving on to cloud, data was moving to data lakes, etc., was much slower than what the rate has been through and after COVID. Right? COVID, as I was saying in a different context, COVID has accelerated the adoption of technology for a variety of stakeholders in the ecosystem of many companies. As a result, corporate level adoption of transition of applications to cloud, moving of data to data lakes has been accelerated as well, right? As this has gotten accelerated, what it has also done is it has led to many of these corporates now deciding to consolidate the vendor base of their IT services, where rather than saying that till 3-4 years ago, the marketing vertical might have been using tech platform of a certain vendor, the HR vertical might be using tech of a certain vendor, sales might be certain vendor, raw material might be certain vendor. When the whole data moves to a single location, and then the organization starts looking at efficiencies by optimizing data sharing and application sharing across verticals, you need probably only one vendor, right? Or very few vendors compared to too many previously. That has led to the demand for IT services not just increasing, but increasing towards vendors who can provide IT services at scale, who can provide a big team of manpower behind the IT service, which is capable of meeting the requirement and scaling it up in future. And this because TCS had always had an upper edge compared to, say, an Infosys or a Cognizant or an Accenture or someone else. This sort of evolution of demand has played into the hands of TCS as a supply of the same characteristic of demand, right? So that is something which has happened in the last 2-3 years that has led to an upgrade in our expected rate of growth of TCS's free cash flows and profits. This upgrade is the reason why TCS went up in our stock selection and position sizing frameworks internally, the longevity framework. It got upgraded there. And then came the choice of either adding TCS as a 15th stock or replacing one of the existing stocks with TCS. Now, if we go back to our whole approach of portfolio concentration, right? There is a gradient of characteristics that we seek on the longevity framework. There is a gradient of characteristics that we seek across our portfolio companies, right? That gradient is downward sloping, right? The downward sloping gradient means n+1th stock in the portfolio will always be lower in quality compared to the nth stock in the portfolio. So the more the number of stocks we add to the portfolio, the more it pulls down the average quality of the portfolio, right? And the fewer the number of stocks are in the portfolio, the more it enhances the quality of the portfolio, right? And hence, concentration is a massive driver of value in consistent compounders in the long run. Obviously, we don't want to concentrate the portfolio so much that it doesn't get diversified enough. It increases the risk, right? So that's the optimization that we undergo. And hence, over the last sort of 3 years of running this at Marcellus, we have never gone outside of a 13, 14 list of stocks in this portfolio. We will not do a 17, 18 stock portfolio. At the same time, we will not do a 9 or 10 stock portfolio. The portfolio concentration will be maintained. Relaxo, in a relative way, was one of the lowest weights already, and lower characteristic score than TCS once we upgraded TCS, and hence we decided to replace Relaxo with TCS.
Great. On TCS, one other clarification. Typically, we look for companies with high returns on capital and high reinvestment rates. In TCS case, the latter is missing, given that tends to sort of give away most of the free cash flow. Is that sort of a deviation from our philosophy, or how do we justify that?
Right. So look, as long as earnings growth is coming, right, and this is a totally intangibles oriented space, right? Capital reallocation towards maybe training centers and offices is what TCS does. Rest of it is creating an intangible asset of capability and creating an intangible asset of controlling attrition rates, right? That drives revenues, more clients, and then that drives profits, right? So the reinvestment of TCS actually happens on the P&L itself, into training, into building culture, into acquiring clients, right? So it is not a company where you need to set up big factories or manufacturing plants. But having said that, it is also not a company which is driving lower revenue growth because of no fixed assets on the balance sheet, right? So that's one way to put it, and hence we are more comfortable with the sort of revenue growth, earnings growth than the reinvestment rate concern.
Fair enough. I think that's a broader point applicable to all businesses in CCP portfolio, and I guess a lot of these new age businesses where a lot of their capex tends to be expensed through the P&L, which has a depressing effect on the earnings and sort of artificially overstating the PE multiples to the extent that it matters as well. Where in this day and age, where most of the investments are intangible, or most of the assets of a company are intangible in nature, people need to make that distinction between what expenses are actually creating an asset and what are more revenue generating expenses. So moving on to other portfolio questions. Of course, Asian Paints and the whistleblower issue, quick take.
Sorry, Asian Paints, whistleblower. Okay. So look, I mean, we did our own homework over that weekend. I remember it was a weekend, and the whole team got together on Saturday to dig out from the accounts of the unlisted entity talked about in that newspaper article. We dug that out. We analyzed the change in ownership of that entity, who owned how much, what was the source of those funds. We also understood from those accounts the nature of the business, that is it a Dabba company, or is it an operating business, which is the unlisted company? It was an operating business. We could see the operations and revenues and profits, etc. And then we also looked at the related parties, right? Separately, we went through a few other disclosures given in Asian Paints' annual report, in some of the regulatory announcements in some of the MCA announcements made by the unlisted entity, which gave us a very clear picture of what was happening here, right? That picture basically told us that related party transactions have not been meaningful enough to begin with. Funding of a related party's ownership isn't being done basis minority interest compromise process. So none of those concerns, and the person in question, the 88-year-old gentleman, to whom around 1.5 crores or 2.5 crores was given in 2008 as a technology fee, right? That person added a lot of value, not just to Asian Paints in various other forums as an innovator around his technical capabilities, and he's got patents in his name in many parts of the Western world, right? In the US and some parts of Europe, and that then sort of convinced us that that this is more a hype that perhaps has gotten created because of one news article. So we for now we are quite comfortable. Obviously, Asian Paints came out with their announcement as well as an answer, but for now we are quite comfortable on that. If more data emerges in future, we will always be on the lookout for a deeper understanding of these things.
Last question on the portfolio is Divi's has been a bit of a underperformer within the portfolio, as well as facing some real headwinds around China and stuff. Any thoughts on that?
I mean, let me look at it like this. We bought Divi's in our portfolio in Jan 2020 when we sold Marico and bought Divi's. At that time, if I remember correctly, we bought Divi's at 1,700 or 1,800 rupees a share, if I'm correct, right? It has gone up multifold from there. I think it is at 4,500 or 5,000 or something like that today. So, I mean, for over a 2-year period, it hasn't disappointed us. Same thing, if you break that down over a 12-month period, it hasn't disappointed. These things happen. That the share prices don't perform, there are apprehensions. There will be temporary reasons at all points of time for these things. Best example, actually, it's worth thinking about, say, Page Industries, right? Now, Page Industries actually did go through many challenges when the share price had also collapsed. But think about it, Page Industries' share price, it went down from 36,000 to 20,000, remained at 20,000 for a good year or two, I think, if I remember correctly. I remember we had done a webinar on Page when the share price collapse happened in the early part of 2019 or mid 2019. Then for a year and a half, it just didn't move. And now suddenly it has gone up from 20,000 to 40,000 over the last 12 to 18 months. So, share prices will be taking a holiday at times. Maybe in the last couple of months, Divi's has taken a holiday, but that's too short a period of time to be worried about it. In particular, fundamentally, we remain quite convinced. Things like the COVID drug, its potential going up or down, I mean, that's not a very meaningful driver of Divi's fortunes anyway. The bulk of the portfolio, it compounds at 20% plus fundamentals without the COVID drug being a contributor.
Yeah. So while we are on that subject, there are a few asking about, on your performance chart, the 1 year number shows an underperformance to the Nifty. You might as well extend that. Effectively, they're asking is, why don't you outperform every single month?
Yeah, I mean, we don't have the capability, unfortunately. Otherwise, we would have loved to. It doesn't matter. Look, you will always see mathematical illusions, and you will always see over a 1 month or a 2 month period money flowing in this part of the market, not in that part of the market. It's very difficult to predict that, right? But when you look at a 1 year period, 1 year period is, I think I would say, at least long enough to make the explanation more around mathematical illusion, which is a very easy one to understand, right? So So think about it like this. Why is it that over a 3-year period, right? Over a 3-year period, the outperformance is roughly 10%. Over a 2-year period, the outperformance is roughly 3.5%. But over a 1-year period, it's underperformance. So what happened here? What has happened here is when you break down the 2 years into the first 1 year and the second 1 year, the first 1 year saw massive outperformance. Year ending 31st March 2020, our outperformance was 33%. Right now, that was because our portfolio did not fall. The 100 rupees in our portfolio, it actually went up to become 108. When for 100 rupees in the market, it went down to 75. Market delivered -25, we delivered +8. This was 12-month ending 31st March 2020. Now, if from 108 we go on to, let's say, 150, and if the market moves from 75 to 120, right? So again, repeating the numbers, we went from 100 to 108 in the first year, second year 108 to 150, let's say. That 108 to 150 is what, 40% performance, whereas the market went from 100 to 75 in the first year, -25. The second year, 75 became 120. Over a 2-year period, we still outperformed the market massively, but over a 1-year period, the market delivered 75 going to 120, which is what I think more like a 70-75% performance, right? That is massive outperformance over a 1-year period compared to our 40% in that mathematics, and hence it's a mathematical illusion. If we fall less, there will be a mathematical illusion on the recovery, right? So let's not worry much about that. We are quite comfortable as long as fundamentals keep compounding at mid-20s and share prices at mid-20s. Beyond a point, the market doesn't matter.
Yeah, I think that also answers the question from this gentleman who's saying, why should I be bothered about what happened then? I wasn't invested. I invested a year ago. The reality is my money hasn't performed as long. But I think the bigger point Rakshit is driving is do not give us any money that you need in the short term, right? I mean, not just us, for example. If you're investing in any equity instrument directly or through a mutual fund or some other PMS, do not invest in equities with less than a 3-year time frame. It simply doesn't make sense. For reasons why that is the case, please read Coffee Can Investing, which clearly demonstrates a lot of data points why the volatility in equity. Equity, by definition, is a volatile asset class, and you shouldn't be investing with short-term horizons, irrespective of what strategy it is. So what Rakshit and I are trying to suggest is look at it from a 3-year perspective. Who knows? There could be a COVID equivalent in the next 6 to 12 months, which will drive the markets down 25%, and Rakshit will deliver another 8% up move. Will be more than making up for this sort of short term. But yeah, if over a 3-year time frame the underperformance sustains, and I'm sure more than you, all of us will be worried for all our savings are in the same fund that you've invested in. Majority of Marcellus's investment team members' savings is in all the portfolios that you've invested in. So we would be as concerned, but at the same time, on a 1-year time frame, we're not worried. So that also brings to our favorite question about, given where valuations are, given where markets are, what about incremental savings that are lying in my savings account? Should I deploy that? Should I wait for a correction? Then again, this is one of the classic FAQs, so it might be worth repeating our stance on timing the market. And I'll just add something around the SIP facility after you finish that, Rakshit.
Sure. So 2 quick data points on that. You should just think deeply about these 2 data points, and it'll give you the consolidated answer. Data point number 1, as somebody else rightly asked, why don't we look at free cash flow yield? So we do not see multiples expanding for the relevant fundamental parameter, right, of our portfolio companies. You can see it here in the table on the right versus table on the left. There is no expansion. The share price progression has been fully supported by fundamentals, and hence, to begin with, share prices are not running ahead of fundamentals. So we are not worried. That's data point number 1. Data point number 2. is this chart that I was showing you. I'll just project it again. Yeah. So if you go, if you look at this chart, this is what the opportunity has got incremental support on fundamentals beyond what was already happening before COVID. These 4 factors are in addition to the capabilities that our portfolio companies had, the opportunities that our portfolio companies had prior to COVID, right? The market share gains in the wake of a crisis for a high quality company in every industry are disproportionately higher than the market share gain without there being a wake of a crisis, right? In the wake of the crisis, the benefit of triple competition means market share gains. Secondly, the capital allocation initiatives which have been taken over the last 18 months are far more accelerated initiatives than normal, and hence the benefits of those in the next 3-4 years will be far more meaningful than normal. Right? Thirdly, the tech investments, as I said in the example of TCS, in the example of our portfolio companies, tech investments, broadly speaking, in the corporate universe have gotten accelerated massively, and that has meant that our portfolio companies who are more tech invested than normal, they are seeing the benefits accrue at an accelerated pace. And finally, raw material cost inflation offers massive opportunities. These 4 things were not available till 2 years ago, right? They are in addition to the core capabilities of our portfolio companies. And hence, if you miss out on investing over the next 2-3 years in this product, what you miss out on are the benefits of these 4 things. Otherwise, what was continuing prior to COVID, in any case, will continue even if you invest in 2025, right? So that's how I would summarize it. And hence, in a way, what happens to the market, whether market goes into price correction, or time correction, or a crash, or a further rally, doesn't really matter. This portfolio, in an absolute way, has got various drivers of further compounding.
Great. I think we've covered most of the questions. If there are any specific questions which we didn't get time to answer, we'll reach out to you, especially if you're a client of Marcellus. But thanks everyone for attending. It's always fun answering some of these questions. For those who couldn't catch or would like to look at the recordings are always put up immediately on our website in the video section, as well as on our YouTube channel. You can look for Marcellus Investment Managers on YouTube. Our channel will have all our webinars put up there that you can watch at your leisure. So thanks everyone. Thanks Rakshit. Take care.
Thank you. Thanks everyone.